All right, let's dive in. Today, we're talking about a critical edge in modern finance, alternative data. We're going to break down how to find it, how to really vet it, and how to use it to potentially generate alpha.
So here's the big question, right? When every single analyst is looking at the exact same financial statements, the same market data, it's like everyone is using the same map. So how on earth do you find the hidden treasure?
Well, it turns out for a whole lot of funds, the answer isn't in those traditional sources at all. They're looking to a new frontier, and that frontier is called alternative data. It's information that you won't find on a balance sheet, but it might be just as telling about where a company is headed.
Okay, so first up, let's really get our heads around this new landscape and understand just how big it's become.
So, what is this stuff really? Well, think of any information that isn't, your typical financial data. We're talking about anything from satellite images of retail parking lots to web traffic data, credit card transactions, or even the sentiment on social media. All of these are clues that could hint at a company's performance way before any official reports come out.
And listen, this isn't some tiny niche corner of the market. Not at all. The supply is absolutely exploding. We're looking at a universe of more than 600 commercial datasets, and about 40 new ones are popping up every single month. It's a flood of new information.
And you can bet the spending reflects that growth. Global investment in alternative data was on track to hit over $7 billion by 2020. This is, without a doubt, a serious, high-stakes hunt for a new edge.
Okay, so the potential is obviously huge. But when you've got this fire hose of new data coming at you, how do you actually separate the real signal from all the noise? Well, you need a clear framework for evaluation. And this is the key question you have to ask. A data set might sound amazing on paper, but does it actually contain a real actionable signal? Or is it just interesting noise? You've got to have a systematic way to figure that out.
So here's a great checklist you can use for that due diligence. You can see the full list here, but let's just touch on a couple of key ones. Uniqueness is absolutely critical. Are you really buying a new insight, or is it just old data that's been repackaged? And the crowding factor asks a super important question. How many other people are already trading on this exact same signal? Because the whole point is to find an edge, not just to join a crowded trade.
Let's just double-click on one of the most important factors here, history. Think about it. A data set that's only 2 years old has probably only seen one type of market. You have no idea how it will perform when volatility spikes or the economy takes a downturn. A longer history is absolutely crucial if you want to do any kind of robust backtesting.
And then there's uniqueness. You have to ask yourself, am I getting a truly new source of information here? Or is this just a fancy visualization of data that everyone else already has? The entire point is to find a proprietary edge, not just another way of looking at the same old facts. Now, of course, this whole process, it's not exactly a walk in the park. Let's talk about some of the most common pitfalls you're going to face when you start digging into these new datasets.
Yeah, we've got to be realistic here. This quote from our source material really says it all. The hard truth is, most alternative datasets just don't have any alpha in them. Your job is to find the rare few that actually do.
So what are these common traps you need to watch out for? Well, we already talked about short history, but you also have to consider limited breadth. A dataset that only tracks the parking lots of 3 specific retailers might not tell you much about the entire sector. And significant noise is a huge one, especially with stuff like social media data. And finally, remember that most of this raw data is messy. It requires a ton of cleaning before it's even close to being useful.
This really lays out the whole history problem in a nutshell. Look at the difference. On one side, a short history gives you noisy backtest results that might just fall apart later. But with a long history, you can do proper in-sample and out-of-sample testing across all kinds of economic cycles. That gives you so much more confidence that your model actually works.
Okay, so we know what to look for and we know what to avoid. So now what? How do we actually put all this together into a rigorous process to test a dataset for that hidden alpha?
All right, so let's say you've done the work, you've found a data set that looks really promising, is past your initial checks. What's next? What's the actual rigorous process for validating its predictive power? It all comes down to a really structured 4-step process. First, you have to formulate a clear hypothesis. What do you actually think this data is going to predict? Is it earnings? Revenue? Step 2, you test that hypothesis on your historical data. Step 3 is that critical check for uniqueness. Does this new data actually add value on top of the models you already have? And finally, the ultimate test. Validate it on out-of-sample data that your model has never, ever seen before.
Okay, there's one last piece of this puzzle we absolutely can't forget, and that's the cost. Getting your hands on this kind of data isn't always cheap, and you have to factor that into your whole evaluation.
Yeah, the price tag for this kind of data is, well, it's all over the map. Some really valuable sources, like certain government data, are actually free, but others can run you into the hundreds of thousands of dollars for an exclusive license.
This chart really gives you a feel for that spectrum. On one end, you've got amazing free data, like the Consumer Financial Protection Bureau's complaint database. In the middle, you have all your commercial subscription services. And then, at the premium end, you find these exclusive deals where a fund might pay a huge price just to be the only one with access to that information.
So here's the bottom line, the big takeaway from all of this. It doesn't matter if the data is free or if it costs a fortune. The real investment you have to make is in a disciplined, structured evaluation process. That's the only way you're going to separate a true predictive signal from just expensive noise.
And that leaves us with one final and maybe the most important question to think about. Is the magic really in the dataset itself? Or does the true alpha come from the creativity and the rigor of the questions you're asking?
Hey, I really hope this deep dive into the world of alternative data was valuable for you. If it was, do us a favor and like, share, and subscribe for more explainers just like this one. Thanks for tuning in.